What I have for you today is an interesting case about hybrid entities. In this particular case, it was called Harbour West LLC, and the case was from 2015. Mr. Anson, who was an investor in the LLC. So Anson was commissioners for Her Majesty's Revenue and Customs. So let's see what was going on. If we look at the facts, the relevant period comprises 7 UK years running from 1997 to 2004. Throughout that period, Mr. Anson was a member of Harbour West Partners LLC. And this was a LLC under Delaware law. The business of the LLC consisted of the management of a number of venture capital funds. It had no economic interest in the funds, but earned fees from its investment management activities. So it was a fund investment manager. The LLC was an agreement between the members. The LLC itself was not a party to it, but it came into being through the agreement, right? And we'll get back to this later. Section 4.2 required that all the gross income and gains realized during the period in question, so during the particular year, shall be credited, and all losses, deductions, and expenses during the period shall be debited to the respective capital accounts of the members pro rata. Mr. Anson's profit share was 11.5%, which was similar to his ownership interest. So what happened was you had, let's say, 10 partners or 9 partners. Each of them had 11%. That was not the case, but let's just pretend. And then as the LLC made profits during a year on a quarterly basis, it would book those profits against the members' accounts, and then, you know, if they made losses, then it took money from the members' accounts. But it was an LLC, so limited liability. They could never take more than they put in, right? That was part of the facts here. Article 5. So that was Article 4. Article 5, I have no idea why it says, Section 4.1, and Article 4, Section 4.1, and now we've got Article 5, which sets out the provisions relating to distributions. So Section 5.1 provided, subject to the provision of this Article 5, to the extent cash is available, distributions of all the excess of income and gains over losses, deductions, and expenses with respect to any calendar year will be made by the company within 75 days following the end of such calendar year, and in such amounts as managing members may determine in their sole discretion. The managing members may from time to time, in their discretion, make additional distributions in accordance with the provisions of this Article 5. And Mr. Anson was not a managing member. And there's something important to understand about this case here, because this is the crux of the case, right? Article 4, profits and losses as they arise get allocated to the members' accounts. But it is the managing members which decide when the money from that account get paid out, right? And it's only to the extent that cash is available, but they can make several payouts during a year of the profits and losses that were already allocated to the members, right? So during each calendar year, all the LLC's income and gains were credited, and all losses, deductions, and expenses were debited to its members' capital accounts on a quarterly basis in accordance with Section 4.2. And what is interesting, the court was very stuck in this case on what Article 4 said and what Article 5 said and what the law said about LLCs. It didn't really look a lot into the practice of paragraph 9, but I guess they might have done so if it turned out that you know, these income and losses were not credited and debited on a quarterly basis, but that would not have been in line with Article 4. So that was part of the facts. And then if we look at what the law and everything said, the following matters of Delaware law were agreed by the expert witnesses. So they had some expert witnesses in this case, both sides had. And the facts were the LLC was a legal entity. Okay, the business of the LLC was carried on by the LLC itself rather than by the members, because it was a legal entity, right? The members, however, were active in the business, each member being required by the LLC agreement to devote at least 90% of their full business time to the advancement of the LLC's business. So even though Mr. Anson was not a managing member, he was still a member and he still had to work in the LLC. The assets used for carrying on the business of LLC belonged beneficially to the LLC, not to the members, and the LLC was liable for debts incurred as a result of its business. The members had no liability for the LLC, and that's the beauty about the LLC. It's tax transparent in the US, so you get all the business deductions, but also get taxed for all the business income. But you're not liable, right? So it's almost like an S corp in that respect. And then paragraph 11 says the first tier tribunal, in this case went all the way through the UK court system, made the following additional findings in relation to the nature of members' interest in the LLC. And it's important that we say the FTT, because the way I understand the court system is it's the FTT that determines the facts, right? And how foreign law is to be interpreted in front of a UK court is not a matter of law, it is a matter of fact. What you then do with it is a matter of law. But the fact is the foreign law says A or the foreign law says B. And the FTT says Delaware law says a Delaware limited liability company interest is defined as a member's share of the profits and losses of a limited liability company and a member's right to receive distributions of the limited liability's assets. We need to come back to this because there's a very big difference in this case between assets and liabilities and between profits and losses. Yeah? In the present case, the LLC agreement provided that a member's interest could not be transferred except for sales by a former member, A, under provisions giving the LLC the right of first refusal, or B, to a person engaged in full-time business of the LLC, or C, on death, right? And that is typically like partnerships. LLCs very often have limited transferability in their shares or in their participations. A limited liability company interest is personal property. In other words, it's a right in personam, not a right in rem. A member has no interest in a specific limited liability company property. So the company's property is separate. And then the interest of a member in the LLC was not similar to share capital, but was more similar to partnership capital in an English partnership, right? And then we need to remember we've got two different partnerships, but we'll come to that. And then the expert witnesses said the following about the LLC, and what, just to understand why it's so important to know exactly what LLC is. The question in this case was whether Mr. Anson was allowed a credit for the tax he paid as a partner in the US in the LLC, or whether that income that he earned in the US was a different type of income than the income that the LLC paid to him. In other words, more like a dividend or something like that, right? And the FTT says the parties' expert witnesses were asked to address a number of questions. One of these are the persons who have an interest in the entity entitled to share in its profits as they arise, or does the amount of profits to which they are entitled depend on the decision of the entity to make a distribution, right? So is this one source of income or two sources of income? Mr. Anson's expert, of course, otherwise he wouldn't hire him, Mr. Abrams, focused particularly upon Section 4.2 of the LLC agreement, since it addressed how profits were allocated among the members, and we looked at that already, and upon Section 5.1, since it governed distributions, right? He concluded that Section 5.1 created a mandatory requirement to distribute the excess of income and gains over losses, deductions, and expenses allocated in accordance with Section 4.2, right? And that is when there is cash. That was consistent with earlier credit of the income and the gains to the members' capital accounts and the debiting of losses and deductions under Section 4.2. The members were therefore entitled to participate in a share of the LLC's annual profits as they arose. The witness was clearly not referring to a proprietary entitlement. He just said, it belonged to them. But the court, especially the lower courts, wanted to know, is this a proprietary entitlement, or not, because if it's not, they say, then it's two different sources of income. And again here we come to this differentiation. Was this a right in rem or right in law, or was this a right in personam, right, a personal claim? And Mr. Anson did not say that this was a right. Mr. Abram did not say that this was a right in rem. The Commissioner's expert, Mr. Talley, treated the question as asking whether the members had a proprietary interest in the profits as they arose. Here we come. Mr. Abram pointed out, and here this is the crux of this case, that assets and profits were distinct concepts in general and under the LLC Act. Section 18101/8 defined a member's interest in the LLC as including a member's share in the profits and losses. The member's entitlement to share in the profits was not affected by Section 18701, and that was Delaware law and stuff, which concerned a different issue, namely the ownership of the specific profit of the LLC. Right? So Mr. Abrams said you're entitled to the profit without making you entitled to the assets. Right? Mr. Talley, which was the expert witness for the government, on the other hand, disagreed with Mr. Abrams' construction of Section 5.1, and in his opinion, distributions were made at the discretion of the managing members. And if you want to, you can pause here and go back and have a look at Section 5.1. And Section 5.1 is not crystal clear on this issue, right? Especially if you as a foreigner do not understand this differentiation between entitlement to the profits and entitlement to the assets. So Mr. Abram then observed that the questions put to him, which linked entitlement to profits to ownership of the LLC's income receipts as they were received, commingled two different concepts. When the LLC earned fees, the dollars went into the company's bank account. Those assets were the property of the company, just as the company's debts were liability of the company. Whether the dollars translated into profits was a different issue, right? Profits and losses were an accounting concept. The LLC Act recognizes distinction, and the LLC agreement imposed an obligation to distribute the profits at the end of the year, not the cash, right? Mr. Talley, in his oral evidence, accepted that profits and assets were distinct concepts in the law of Delaware. He maintained that profits nevertheless had to be reflected in the assets on the balance sheet and in the sense formed part of the assets. He stated, however, that his primary reason for considering that members had no entitlement to a share in the profits prior to a decision of to make a distribution was his interpretation of Section 5.1 of the LLC agreement as rendering distributions discretionary. So he stuck to his horses, basically. And then in the discussion, the FTT stated that it accepted the contention advanced on behalf of Mr. Anson and supported by Mr. Abrams that in summary, Article 4 allocated the profits to the members as it arose and Article 5 required a payment to be made. In relation to these methods, the FTT concluded, in summary, our conclusion is that the combined effect of Section 1815.03 of the Act and terms of Article 4 means that profits must be allocated as they arise among the members. It follows that the profits belong as they arise to the members, right? Article 5 dealing with payments is irrelevant in this conclusion, and Mr. Anson won before the FTT, and he was entitled to get a tax credit under the UK-US treaty for the tax that he paid in the US, because the LLC is not taxed in the US, it is his members that are taxed, right? And then the FTT goes on to say Mr. Anson was at all relevant times a UK resident and ordinarily a resident but not domiciled, so he was a non-dom. He was consequently liable to UK income tax on income arising from possessions out of the UK, which he remitted out of the UK, so outside of the UK, which he remitted to the UK. So the non-dom status, for those who don't know, is when you are very rich and you want to live in a first world country, you move to the UK, and the wonderful thing is as long as you leave your assets offshore, you don't pay any tax on it, but only when you bring the money onshore are you taxed on that income. And that, I'm not sure they have this status anymore, but it was a long-standing UK law, which explained the number of wealthy people living in the UK to a large extent. Mr. Anson paid taxes in the US on his share of the profits at the rate of 45% and income tax and remitted the balance to the UK. The question is whether he is liable to pay UK income tax on that balance at the rate of 40%, producing what he said would be an effective tax rate of 67%, or whether he was entitled to double tax relief. Mr. Anson claims double tax relief under Section 23(2)(a) of the UK-US Double Tax Convention. And Article 23(2)(a) reads, US tax payable under the laws of the US on profits from sources within the US shall be allowed as a credit against any UK tax income computed by reference to the same profits, right? And there were two treaties, the 75 and the 2001 treaty, but they were largely the same. And remember, this case ran from the 90s, the mid-90s, till 2004. So both treaties were applicable, but the courts only look to the 75 treaty because there were no significant differences. Now, what happened further before the first tier tribunal was it is said, a spectrum running from the English partnership, where the partnership had no separate personality and the partners owned the assets jointly, through the Scottish partnership, where the partnership was a legal person, but the partners were entitled to profits, to the UK company, where the company was a legal person which owned the assets and the members were normally entitled to profits only after a dividend has been declared. So what the FTT was now doing is they say, we know what the LLC rules are. Now let's look at the UK entities and see whether the LLC looks most like an English partnership, a Scottish partnership, or a UK company, because then we will know how we should treat the income, right? And then the FTT said the LLC stood somewhere between a Scottish partnership and a UK company, having the partnership characteristic of members being entitled to the profits as they arise and owning an interest comparable to that of a partnership interest, but also some of the characteristics of a company, having only limited liability, right? The factor which the FTT said it was mainly concerned with in relation to the convention was whether the profits belonged to the members as they arose. It had concluded that that was the effect of the LLC agreement. Accordingly, it said the appellant is taxed on the same income in both countries. Mr. Anson therefore succeeded on the first issue. But then HMRC was not happy with this, and they decided to appeal the case. And they first went to the upper tribunal and they won. The commissioners appealed and Mr. Anson cross-appealed on the respect of another UK tax issue, not important for the treaty issue here. And the upper tribunal, Man J, the judge, reversed the decision of FTT, so Mr. Anson lost. And then Mr. Anson appealed and went to the Court of Appeal, but the Court of Appeal refused the appeal and Mr. Anson lost again. And then